Hi everyone, and welcome to our May HUBsights webinar. I'm Anne McDonald from Hub24, and I'll be moderating the webinar today. This webinar series is held on a monthly basis, and this covers a range of useful topics for advisors featuring our managed portfolio partners. Today we are fortunate to have Andrew Connors and Mathew Jeremy from Quilla Consulting, who will present on the current market outlook and portfolio allocations, followed by Lukasz de Pourbaix from Lonsec, who will explore Is Up the New Normal. Just before we kick off, I'll just quickly cover off some logistics. We will have the lines muted during the presentations, but we'll open up the lines at the end for Q&A. I'd like to ask you to make sure your lines are muted unless you'd like to ask a question to prevent any background noise. You can also submit a question at any time during the session through the webinar control panel on your screen. I'd now like to hand over to Andrew and Mathew to kick things off.
Thank you, Anne. Mathew Jeremy here. Hello, everyone. Good to have you with us today. I'm going to spend a few minutes talking with you about some of our headline global macroeconomic views and their implications for a couple of major investment themes that we have in hand at the moment and how that translates through into our portfolios before handing over to Andrew to talk about some other aspects of what we're doing. So let's start with the world and Australia. Look, the last few months we've seen some pretty good growth conditions around the world, positive surging growth, PMIs both overseas and here have moved up to levels that we haven't seen for quite some time, and the equity markets have very happily priced that. High yield has very happily priced that as well. Now there seems to be a general expectation at the moment that those conditions are going to continue for some time yet. We're not quite as confident about that. When we have a look at the key drivers of that surge in growth that we've seen, and that includes the rise in the price of oil, the stimulus in China, and the easier monetary conditions in America, pardon me, all of those things now heading in the other direction. The other key thing is that the US dollar has appreciated quite a bit over the last several months. When you have a look at the relationship between that and the key PMIs and economic activity indicators in the States, it's quite clear that over the next 6 months, that US dollar appreciation is going to act as a drag on US economic growth. So our view is that this surge in global and domestic growth that we've seen in recent months is in fact going to fade over the next few months. Next 3 to 6 months, it'll fade and ease back. But we're not expecting anything like a hard landing in China. We're not expecting any sort of global recession. So still reasonable growth, but just not as much as the markets currently seem to be expecting. Now, we're facing some possible fiscal stimulus in America sometime this year. That could obviously provide some support. The trouble is we don't know when that's going to happen. We don't know, that is when it's going to be announced. We don't know what's going to be announced. But the odds are it's not really going to have an impact until next year rather than in this year. Similarly, the budget that came out last night here, we don't think that's going to have much of a material impact on economic growth in this year and not until sometime next year. In terms of inflation, both here and in the States, we've thought for a while that inflation this year was not going to be as big a problem as the markets had been talking about, and that's pretty much come to pass. We continue to think that inflation is going to be reasonably well behaved through the rest of this year. It'll pick up a bit next year, but we don't see it getting out of control. So inflation is not really a threat, but most importantly, inflation is not going to be going down anymore. I'll come back to that in a minute. One of the implications of that is that the interest rate easing cycle is over. So we know that in the States. I mean, the Fed's already started to act. We think the Fed will continue to lift the cash rate, take opportunities to do that wherever it can, because it has so much work to do. When you have a look at the relationship between the real cash rate and the economic cycle, the real cash rate in the States is 300 basis points below where it should be. So they've got a lot of territory to catch up. In terms of Australia, we think the Reserve Bank will leave the cash rate where it is until middle of next year, and then maybe we'll see some modest tightening. Non-oil commodity prices we think are going to go down, and the oil market, we think the oil market is inherently unstable, and OPEC's efforts to hold the price are fundamentally threatened by what the American producers are doing. So we see downside risk to the oil price as well. So let's take that view and have a bit of a chat about equity markets and the currency. Let's first think about valuations on equity markets. So this chart shows the forward PE for a range of countries compared to their historic ranges. And it's pretty obvious, standing out there on the left-hand side, that relative to its own history, the Australian equity market is right up there. It's looking pretty pricey. There are a few others in there as well. America doesn't look, that bad, but nevertheless, it's still up there. This data, by the way, runs back to 1990. And, it's only countries like Russia that are in, dire straits that have relatively cheap equity markets. The important thing about this is that with these valuations in elevated territory, they've got there by virtue of the multi-year interest rate easing cycle on the back of low inflation. That's what's driven it. It's very clear, particularly in the States and in Australia. We think that story, as I alluded to a moment, is over. That re-rating theme is done. So even if the Reserve Bank isn't going to be putting up rates until the middle of next year, they're not going to be putting them down either. Inflation's not going to go down. So the risks in a number of countries, including here in Australia, here in the States and increasingly in Europe, are skewed against further PE re-rating. When we move on to the implications of that growth outlook that I was talking about for the equity markets, this chart shows the blue line is the 6-month rate of change in the S&P 500 risk premium, basically the performance of the equity market over the bond market, and that's compared to the red line, which is the 6-month rate of change in the ISM index, measure of growth momentum, which of course is a proxy for profitability. And a couple of things stand out from this. First of all, you can see that the equity market pretty much has priced, whether on this measure or in other ways of looking at the data, pretty much has priced the rise in the ISM, that growth surge. But where does it go from here? In order to have the equity market take another leg up, you have to believe that those PMIs are also going to take another leg up. Given that they're already at very high levels historically, and we think the growth drivers are rolling over, it's hard to come to that conclusion with a whole lot of conviction. So what we think is that even if the PMIs finish, 12 months' time, they finish at the level they're at now, that still takes you to virtually nothing in the way of economic growth in the S&P 500, and more likely the PMI is going to finish the year below where it is now, in which case you get a potential negative return on the S&P 500. And the same thing can be seen in other countries. The same sort of analysis can apply. So valuations don't look great. Earnings momentum looks challenged. And then you get to this one, which is this chart, which shows the blue line is the VIX volatility index compared to the price of oil. Now, the price of oil is on the right-hand side and the scale is turned upside down. So as the red line goes up, it's the price of oil going down. Why? Because there's a positive relationship between oil price and the S&P 500, and there's an inverse relationship between the S&P and the VIX. So what does all this mean? One, the VIX is at record low levels. It's just gone sub 10 in the last few days. Hasn't been that low since 1993. Now, we've seen very much in recent years that the relationship between oil and the US economy has changed, and as the oil price goes up, the US economy does better because of the energy sector over there is a much bigger part of the economy now than it used to be. So what happens when the oil price goes down is that indicators like the ISM go down as well. And when that happens, the equity market tends not to like it. So oil price down, equity market goes down, volatility spikes up. So the point of this chart is you've got the volatility index at record lows. There's a lot of complacency in the equity market over there at the moment. It only takes something like further declines in the oil price. North Korea, Trump does something crazy. China, does something in the South China Sea. Name your geopolitical risk of the day, and the equity market is vulnerable, we think, to some sort of shock, which would then, push the VIX up, volatility goes up, and as a result of that, the equity market is simultaneously going down. So, given all of that, you won't be surprised to hear that we're cautious about equities, and I'll come back to that in just a second. Let's talk about the Australian dollar, which is one of our other, big themes that we've been working with for a while. This chart shows the Aussie dollar versus the US is the blue line, and the red line is our medium-term macro leading indicator of the currency, which we've been using for quite a few years now to great effect. You can see over on the right-hand side, the red line it's heading down. It suggests the Aussie dollar should be sub 70 cents. Now, of course, it's been higher than that recently. The increase in the iron ore price has helped push it up there. Some dithering around from the Fed has helped keep it up there as well. Those two conditions are gone. The iron ore price has dropped 30 to 40% in short order. We think it's going down further, and the Fed's dithering is over. So basically, we think that the Aussie dollar is going to converge to this indicator, and we expect it to be below 70 cents sooner than people think. Because when the market moves, and you can see this happening right now, when it gets the bit between its teeth and decides the currency is going down, it prices it quickly. So we expect the Aussie dollar to be below 70 cents in coming months. When you take all of that, plus some of our other macro analysis, and we put it through our short-term global macro model that generates our 12-month forecast horizon, you come up with this mix of numbers. And I have to say, this is probably the ugliest set of expected 12-month returns we've seen for quite some time. Why? Because all the positives are very small, and there's a whole bunch of small negatives in there as well. And as you can see, just scanning down the left-hand side of the axis, REITs do badly. Why? They've had great outperformance, but on the bond market rally, we think both of those are over. Hedged international assets, no, they don't do very well. Domestic small caps also have underperformance. And that's because these things are pro-cyclical outperformers. So, we think the economy is going to slow down a bit. You'd expect those assets to underperform as well. The only things that have decent expected returns, if you can call 4 and 5% decent, is, as you can see, the unhedged equity complex down the bottom there. Why? Because as you can see at the very bottom, we've got an expected depreciation of the currency in the order of 6 to 7%. And that's what's putting those returns into the positive category there. Now, one of the things that we do is not just this 12-month macro model forecasting, but also our broader 3 to 4 year scenario analysis modelling gives very similar results on these numbers. And so what we have here is increased conviction in our view about where the risks and the opportunities lie, based on the alignment between our short run and our medium term forecasting. So what all that means for the portfolios at the moment is that we have reduced the allocation to equities across the board, particularly domestic equities, eliminated REITs, eliminated small caps. To the extent that we have equity exposure, we obviously favour unhedged developed market equities. We have some overweights to alternatives. We have some overweights into the fixed income complex. But particularly where we can in the fixed income complex, we prefer specialist credit strategies, syndicated loans, things that don't have exposure to duration or to basically market beta. I'm going to pause there. So the final thing that I would say is the portfolios at the moment are particularly well diversified to try and cope with these challenges, and that's been working pretty well. I'm going to hand over to Andrew now to pick up the story.
Thanks, Matthew. I'm one of the co-portfolio managers of the Quilla portfolio. So I'm just going to spend the next 5 minutes or so just wrapping up all that information that Matthew's been able to provide and put that in context of how we actually manage the portfolios. And I think one of the important things Matthew made at the end there, one of the important points he made was that we have significant amounts of diversification in the portfolios. For us, looking at our 12-month forecast, for instance, like was just highlighted in the previous slide, that is one set of forecasts that we use in the portfolio design. However, it's not the only way we position portfolios. It's not the only input we use when designing a set of optimal allocations. So it's looking at we also look at our medium-term allocations. We also look at a whole raft of stress tests or scenario analysis. 30 to 40 different potential scenarios that could play out to test the viability of the portfolio that we have at that point in time. And that really guides us on appropriate diversification, and it reduces that forecasting risk that is always present if you are projecting out the future. So that's a really important part of our process that results in very well diversified and well insulated portfolios. The other aspect of our portfolios that I wanted to highlight is the flexibility that we have to actually implement on our views. And this is a really important point to bear in mind for goal-based portfolios in particular, who typically will have a CPI plus type target or a potential or a risk target. Being able to achieve that objective with the highest possible probability is really dependent on, or partly dependent on, the ability of the fund manager, the portfolio manager, to implement those views. And we believe having very wide ranges enables us to be very active in the way we position portfolios, whilst also bearing in mind all the different scenarios that we consider when designing a portfolio. For example, when we have a view on a particular asset class, for instance, our view on government bonds is and has been particularly bearish for a long time, we would look at other options to achieve a defensive allocation in the portfolio. And we would look at things like, as Mathew highlighted, credit exposure, short duration bonds, or syndicated loans as methods to achieve that defensive component to the portfolio, those uncorrelated return streams. And if we believe in that conviction, and if after all the stress testing and scenario analysis we conduct, we are still have a strong conviction on that information, then we will move out of that asset class and into those other strategies. We don't need to maintain any sort of fixed allocation to government bonds. The same goes for an A-REITs, the A-REITs example we've got there in the pack. We've done fairly similar things in both domestic and global equities over recent months, as our short and long-term forecasts have aligned. So as Mathew once again highlighted, our conviction and our belief in those views is very strong because of that alignment in forecasting. And as a result, we've significantly reduced our exposure to those two very core building blocks to a portfolio. Ultimately, I think all this is all about managing the downside. What we're really trying to do is mitigate losses in portfolios. You've all heard the saying, the best way to make money is not to lose it in the first place. That is a proven fact. You benefit better from compounding over time if you don't lose money. And with that in mind, we employ that dynamic asset allocation process and those wide ranges to really drive risk mitigation in the portfolio, while still achieving the desired return objective that we have for each strategy that we run, each of the 6 strategies that we run on the HUB24 platform. Now the proof points, I won't spend too much time blowing our own horn here, but the proof points are in the analysis in front of you here. So this is just a highlights to you how 3 of our portfolios have been able to beat the composite real return index. The composite real return index, as it says there, is comprised of other goal-based or real return strategies. And clearly all 3 of the strategies that are broadly consistent with that universe are significantly outperforming the universe as well, because of that active management that I talked about before. And the chart on the right just highlights that same peer relative analysis looking at different time periods. That's all I wanted to highlight today in wrap-up. This is just an outline of some of the different types of reports and analysis and collateral that are available for supporters of Quilla. If you're not familiar, if you haven't seen any of this analysis, then please do get in touch with Mathew or I, and we can provide that collateral to you. So I'm more than happy to discuss that in more detail offline. But thank you very much for your time. Mathew and I very much appreciate the opportunity to talk to you. We're going to be taking questions at the end of the session, so please hold your questions till then.
Thank you very much, Mathew and Andrew. Some great insights there and some great information on what's happening within your portfolios. So I'd now like to hand over to Lukasz from Lonsec to take us through his presentation.
Great, thank you very much, and thank you to the Quilla guys for their presentation. What I'll be talking about today really is, the theme is up the new normal. I mean, everyone's been sort of fairly excited post the Trump election. We've seen that in some of the market returns, certainly being amplified in more recent months. So are we entering in an environment where that sort of buoyancy is the new normal? That's sort of some of the key points I'll talk about. I guess where the markets have been, talk about some of the things we're observing in terms of the various styles and some and how they're performing in different markets, and also broadly some portfolio construction implications. So if we get started, if you look at this, is a chart just showing the S&P 500. That's the blue line, and the ASX 200 index. That's the red line. And you can see there that it's been pretty much one-way direction for some time. Over 5 years, S&P 500's generated about 20% per annum. Over the same period, Aussie equities have done about 10%. So if you think about from a long-term perspective, our long-term sort of expectations for equities is around the 8% mark. So certainly exceeding those long-term expectations. Over that period, we've had Brexit, we've had a Trump election, we've just had the French elections, and markets certainly haven't blinked. So part of that has been what's been driving this buoyancy. Certainly part of that has been attributed to the low interest rate environment, which has been supported by quantitative easing. But also we have seen an improvement, certainly over the last sort of 12 months or so, in some of the economic indicators as well. And both of those things have certainly contributed to some of that buoyancy in market. So what are we thinking about? We operate in terms of supporting our portfolios, a quarterly investment committee where we think about a variety of things. And in our last investment committee, some of the key things we sort of focused in on is where valuations, where are we with the economic cycle, and you can see there's some of the other points. And some of the key points we'll say is that from a valuation perspective, if you look across the market, look, valuations, pick your valuation metric and you might get a slightly different outcome. But generally what we would say is that valuations are generally priced around fair value to expensive for most sectors, and certainly there's no screaming buys. So if you purely focus on valuation, there's nothing there that looks particularly cheap, and valuation is a long-term indicator. So valuation tends to play out over a sort of probably 3 to 5 year period, and if that's sort of the process you undertake, then certainly nothing is looking necessarily cheap. In terms of economic indicators, and I'll touch on this a little bit more, you've seen some general improvement over the last sort of 12 months. So, and I'll touch on it more, but certainly things like the Purchasing Managers Index has been improving, unemployment has been coming down, and all of this has assisted in driving some of the broader economic growth. In terms of the US, obviously a lot of focus has been on the recent US elections, and particularly on the pro-growth type strategies. Our view would be that the market has priced in a lot of optimism in terms of President Trump being able to implement these pro-growth strategies. And so the risk here is if there's any risk of shortcoming in terms of being able to implement some of these pro-growth strategies, then you will potentially see a bit of a pullback in markets. And already you're seeing some of the issues the Trump presidency is having in pushing forward some of their policies through the Senate. The other key thing is momentum is certainly very strong in markets. So if you look at sort of traditional price momentum indicators, and I've got some charts that will show this, momentum is strong. Market volatility is low, as we saw in some of the charts previously. I'll give some other context around that. And then geopolitical risks, look, we are, I guess, in a heightened period of geopolitical risk. Now, it is hard to predict what impact and when these things occur, but needless to say, we are in a period of this heightened, I guess, geopolitical risk. So overall, we would remain fairly cautious in our portfolio positioning at this stage. If we look at some more specifics, you look at the Aussie equity market. Now, in terms of valuations, as I mentioned, there is a variety of ways you can look at valuations. If you look at cyclically adjusted PE ratios, we've got it about fair to slightly above fair value at the moment. On other measures, it looks more expensive. And certainly they've had a really good run. In recent months, you've seen the resource sector drive a lot of that performance. However, interestingly, in more recent periods, you've seen a bit of a pullback there, and some of those more defensive type sectors perform a little bit better. So we would, from our perspective, we would like to see a bit of a pullback in the market for us to warrant a higher allocation to equities. But that's where we see equities, Aussie equities at the moment. If we go to global equities, similar story, very strong market. Valuations, I guess, are mixed depending on the region, but again, probably generally would have it to being overvalued to fair value across the various regions. And we do think, as I mentioned before, that the recent rally we've seen, certainly from US equities, has been maybe a little bit overdone on sort of anticipation that Trump will be able to execute on a lot of his strategies. We are seeing some divergence between regions in terms of markets, and I think what this tells us is that certainly if you're a quality active manager, you should be able to exploit some of that divergence and inefficiencies in the market. If we look at bonds, you know, for many years, people have been saying that bonds are expensive, and certainly that has been the case. And most people have, from a portfolio return perspective, that certainly hasn't played out because bond yields have continued to come down. But what we are seeing at the moment is the yield curve, both in the US and in Australia, steepened. So while bonds are not particularly attractive at the moment, but they're certainly not looking as expensive as they were. But at the same time, it also depends on the magnitude of rate rises. So I think consensus is that rates will go up, but there's, I guess, some debate as to how the extent and magnitude of that. And our view would be that there will be a steady rise. And even if you see the Fed, everyone's sort of baking in a rate rise, but you know, they are being fairly cautious at the moment. If you look at the economic signals, as I mentioned before, you have seen some of the economic signals improve. Things like the PMI is above 50 across a lot of regions, which is typically a positive indicator. Jobless claims have been coming down, but a lot of this data is on trend, and some of the positive data coming out, things like consumer sentiment and the PMIs are sort of softer economic indicators. They're survey-based indicators, and some of the harder, I guess, indicators we would argue are on trend. But certainly there has been an improvement in the overall economic environment over the last 9 months or so, and that has added to equity markets over that period. If we go on to the next slide, one of the key things to note is, one of the key things we look at is also sentiment in the market, and one of the things is just looking at simple price momentum. So the chart there on the left, looking at the moving averages, the sort of purplish, I don't know what you call that colour, but anyway, it's called purple, line is the price, ASX 300, and then you've got a longer term sort of moving average, 200-day and the 50-day. When you get that shorter term moving average crossing the longer term, I mean, it is indicating that there's fairly strong momentum in markets. You see the similar story in global equities, and volumes have been generally fairly strong in equity markets. So again, you know, the markets have been supported by momentum. Yes, there has been improvement in earnings, but we think that the markets has maybe overshot in terms of where they're at the moment. And one of the next things that we look at is the VIX. So Mathew was sort of talking about this chart, and it is at very low levels. It sort of measures the implied volatility of options for the S&P 500. You know, typically it is used, you know, when you see very low levels of VIX, you know, you've got higher momentum, you've got equities that are not necessarily attractive on a valuation perspective. There's always those left field events with it, which is difficult to predict for, but we would expect that volatility will go up. Interestingly, another thing that we have looked at is the skew index. So it's actually produced by the same guys that produce the VIX index, and effectively what this measures is the level of out-of-the-money options on the S&P 500. So in other words, the level of tail risk hedging. So what, you know, there's different ways of interpreting this, but certainly one interpretation could be that people are taking out increased protection as well. So while momentum is strong and has been this buoyancy in markets, at the same time we've seen an increased level of out-of-the-money options being taken out of the market, which again could be influenced by a variety of factors, but we would suggest that there's, you know, markets are nervous, you know, while they've been optimistic, they're a bit nervous as well, which is maybe warranted. One of the other things we've certainly seen in recent times is growing divergence between fund manager performance. One of the key factors over the last 12 months has been the rise of value. So if you think about it, post GFC for up until the last sort of 12 months, growth has absolutely dominated. So if you've been a growth manager, long US, you have generally outperformed the market over that period. And, you know, funnily enough, that has also resulted in a lot of issuance of products of that style. Nothing like launching products with good performance. But over the last sort of 12 months, we've seen value kick back. So value was out of favour for about 5 years or so. As I indicated below, value is a long-term sort of strategy. So we have seen that come back to fruition, and therefore it is just an example. You've got Alan Gray, who's a traditional sort of value, deeper value style manager. Over the last sort of 12 to 18 months, really performed really strongly relative to your more sort of growth core style managers. And we're seeing that across the board, increased divergence between manager performance, particularly in the bond market as well, which would suggest that, you know, picking your managers will be critical. The next sort of chart just sort of gives you some more context around that style rotation. Basically, this is just looking at the various styles in the market. If you look at the blue, the left bar, left-hand side, you can see the blue indicators. They're your traditional sort of value type measures, and you can see that value over the last sort of 12 months has done really well. Interesting, on the far right-hand side, you can see the sectors that have also done really well. Things like materials of energy, which you know, so any manager that has, you know, probably lagged for a significant period of time, if they've had that exposure over the last 12 months, has done really well. So again, it's, you know, when we're building portfolios, we're really looking at to understand what are the various exposures that the managers have within their portfolios, and ensuring that we're not overexposed to any single factor that can actually then really skew your whole portfolio and obviously impact performance. If we go to the next sort of slide, so we manage a range of, I guess, SMA portfolios via HUB, including some direct equity portfolios and more diversified portfolios. And I won't go into each strategy, but I guess some of the key things we're thinking about on the equity side, we do adopt, I guess, what we call the quality at a reasonable price. So we're looking for companies with strong ROE, with low leverage and so forth, within industries with some tailwind. So some of the I'll put up some examples of some stocks that we're holding at the moment: Transurban, CPU, and Challenger. And if you think about, for example, a stock like Challenger, some of the rationale behind that is, you know, we are expecting the yield curve to rise, which we have witnessed in recent times, which is net benefit to annuity rates, and in terms of sourcing new investments. And obviously the broader thematic of the aging population does play into a lot of the products that company issues into the market. And we would sort of say, from our perspective, it's probably one of the high quality insurance life plays at the moment. And that just gives you a sense of, we're looking at stocks from a, you know, bottom-up perspective, looking at the industry they're in, looking at valuations, and really looking at that broader thematic as well. In terms of our diversified strategies, so some of the retirement strategies that we operate and accumulation strategies, the key thing we would say is to diversify by strategy. So it's not even saying, you know, diversify in terms of the managers you have, but really understanding very clearly what the role of each manager is within the portfolio. We sort of, at a very high level, break it down into a couple of key factors that we look at. So one is, what is our beta exposure to the market? And that simply means, what is that type of manager or listed instrument that gives us that market exposure? Now, that could be a long-only manager, they could be an active manager, but in effect, it's giving you that long-term exposure to the market. The other aspect we're looking at is the risk control part of our portfolio. So what is that type of investment that gives us a bit of a handbrake, a bit of a buffer within the portfolio? Particularly if we think a risk to the downside is increasing, what are those strategies that will assist in that process? And that may be, I mean, I've got the Alan Gray Aussie Opportunities Trust as an example. There's others, but, you know, managers that maybe can use cash, for example, as a lever of managing their market exposure. So that's one way of doing it. And finally, what are those alpha strategies? So those type of strategies where we think you can generate alpha and a good example would be things like small caps, and Spheria is our preferred allocation at the moment in terms of small caps. So that gives you a bit of a sense of how we think about, I guess, portfolio construction. If we look at the next slide, it just gives you some of the key stats in terms of the portfolio. So this is for the Aussie Equity Core portfolio. As you can see, it's a quality at a reasonable price type portfolio, low turnover. We can go up to 40%, but historically it's been about the 20% odd mark. Lower beta than that of the market, and that's because we are sort of looking at that quality end of the market. And you'll see we don't tend to have a very high exposure to some of those more cyclical parts of the market, and it is a fairly concentrated portfolio. So looking at about 15 stocks, and you can see there the tracking area is about 4.6 at the moment. If we go on to the next sort of slide, it just gives you sort of the performance over time, and we've imagined this portfolio for over 15 years, and you can see that over time we've added value above the benchmark. One of the other strategies that we manage is an income-focused Aussie equity strategy. Now, the focus here is really to keep pace with the benchmark, but to generate a higher yield than that, and franking level than that of the portfolio. And therefore, the portfolio will target those sectors and those industries and those type of companies which have those characteristics. If you look on the next slide, then you can see that over time, the grossed up yield has been quite competitive, certainly if you compare to what the benchmark has done, and even if you look at some of the ETF, high yield ETFs in the market, we've certainly exceeded that. And as we're seeing that thematic of people wanting yield as cash rates come down, this is certainly one way of accessing that. More broadly, we do also run a range of diversified strategies. We're using a range of managed funds, and one of those strategies is a retirement set of portfolios. Now, one of the key things to think, you can see there, the main thing with retirement, we know that there are different objectives, that people are looking to generate income. At the same time, they need to generate growth because of longevity risk. So you need to have growth in the portfolio, but you also are exposed or at greater risk at downside risk, because if you lose capital in your retirement phase when you're drawing down, that has a greater impact on the longevity of your portfolio compared to an accumulation portfolio. So we construct those portfolios with three key building blocks. So growth, which gives you predominantly sort of equities type exposure; yield exposure, which is a basket of yield producing investments from equities through to cash, with a primary focus of generating yield; and then risk control. So those type of strategies which can buffer your portfolio in the event of downside. And you can see over time the income has been fairly consistent over time, and in terms of absolute returns have been fairly good as well, and we've performed better on the drawdown than the market in most instances as well. So in terms of I guess the key takeouts, look, market performance has been strong. At the end of the day, investors have benefited. I think we've had it's been a good outcome, so we're not being pessimistic about it. I think investors have had good returns for a number of years, certainly above long-term expectations. We are seeing momentum factors really driving markets at the moment. Volatility is low as well. I think we generally think the markets may be overshot a little bit. We would be cautious. We would try to think about what are those things in your portfolio that can provide you with some downside risk management. And really, it is about diversification of strategy. So ensure that your portfolios are not anchored to one type of factor, or that has maybe worked in the last couple of years that maybe won't work in the future. So diversification of strategy is important. If we this just gives you a summary of the SMA portfolios we currently have on Hub. I won't go through those in more detail, but that's just for your information, and certainly please reach out to us if you do have any more questions around the strategies themselves. And then finally, here just our contact details. If you want to contact me directly, by all means do so, or my colleague Mathew Bakari, who leads our business development capabilities for our SMAs. So thank you, and I believe that we'll have time for some questions.
Yes, thanks, Lucas. Lots of food for thought there, particularly around portfolio construction. So I'll quickly, I'll open up the lines now for questions. And just in the meantime, Lukasz, you mentioned that resources had been running hard and had recently pulled back. Do you think there is some more room for growth in the resources sector?
Look, in terms of the resource sector, the market may continue to, in the short term, to rally. However, some of the key broader issues we're looking at is China, potentially slowing to a degree, hidden debt in China, which may then pose risk to the iron ore price, risk to copper and coal. Oil, there has been a story, is more of an oversupply. The industry has adapted to lower prices. No one seems to be cutting production, so we don't see a rally in oil prices at this stage. So from our perspective, we're still fairly cautious on we are cautious on resources at the moment and remain underway.
Okay, thank you. Yep, and we've just had a question come in from Jason Hawthorne.
Oh, hi. Thanks very much. Really appreciate it. So the anniversaries of the 87 and 07 highs of stock markets, do they create concerns looking forward as to the potential increase in the VIX to markets?
Look, not really. I mean, it's a curious thing about financial market psychology that big figures in index levels or symmetries in calendar dates can focus people's attention in funny ways. So, look, we wouldn't really expect just the calendar effect to be a catalyst. You never know what the commentaries might be at the time. Look, we think that the markets are at a point at the moment they're sufficiently complacent that an event could pop up at any time to disturb that complacency, spike the volatility, and bring the equity markets down to some extent. And between now and October, there's plenty of room for that to happen.
Probably one thing I'd add to that, we're probably, if you look at the average length of market cycles, and it's different numbers thrown around, but on average it's about 6 years. So we're sort of around that ballpark figure. Nothing to do with the dates that you mentioned, but it just happens to say that is the case. So again, that we could, markets can continue to go on for a little while, but we're probably sort of at the late stages of the cycle as well.
And Andrew and Mathew, you mentioned that equity markets are getting expensive in Australia, noticeably so. Do you think there are any markets out there where you still see value?
Yeah, so I think Australian market has certainly surged ahead over the last 6 months since November, really. We do put the US in that same basket as well. So we look at cyclically adjusted PEs, Graham and Dodd PEs, sitting at around 25.5 times in the US market at the moment, which is, depending on the measure, about 20 to 30% above what you'd normally expect over the long term for that particular market. In Europe, for instance, we're looking at their cyclically adjusted PE at about 20 times earnings. That's also higher than their long-term average. UK equities, they're sitting at about 16 times, and that's slightly higher. So look, there seems to be some better value to be had in the UK market relative to the current level, relatively to the trailing 10-year earnings from that market. Japan, slightly overvalued. China, on these measures, sitting at about fair value. And some of those other Asian countries as well are looking like they might present better value relative to their long-term trailing earnings as well. So countries like India, etc. Okay,
thank you. So I think that's all for questions. Thank you very much to Lukasz, Andrew and Mathew for joining us today. Keep an eye out in our newsletter at Hub for who will be presenting at the next monthly webinar and what date that will be. Thank you very much for joining us today, and hope you all have a wonderful day.